Hey everyone, in this video I've got one growth stock that's down 74% off its high that you can go ahead and buy now. So what is this growth stock? It is Him and Hers Health, HIMS. And this telehealth company has done a good job growing revenue. So let's look at that revenue growth next here. Over the last several years, HIMS has done a good job growing its revenue from less than 200 million up to 710 million, and I suspect revenue growth will continue over the next several years. Now it's just so much more convenient to do your doctoral visit over the internet or over the phone versus having to go in person, and Him and Hers Health helps facilitate those visits, and I suspect more and more individuals would prefer this kind of visit versus having to go to a doctor's, find parking, pay for parking, wait in the office, and all the other inconveniences that go along with visiting a doctor's office. I think you can get a visit and consultation done in less time over the phone or over the internet than you could in just visiting and finding parking at your local doctor's office. So I hope and I'm rooting for this company to continue making things more convenient, investing in the technology that's needed to facilitate more of this type of visitation in the future. And one of the things I like about Him and Hers Health is the company's using its revenue growth to expand its profitability. You can see operating profit margin rising from a low of negative 40% in January of 2022 up to negative 7.33% in the most recent update. If this trend continues, I wouldn't be surprised if in 2 or 3 quarters time I look back at this metric and it's positive. And so this is something that I like to see in growth companies, is not just growing for growth's sake, but growing so that you can increase profitability and start to generate profits on the bottom line. And a similar story for the company's cash flow. It's reaching a scale where it's now generating positive cash flow from operations after decreasing to a negative close to 50 million around July of 2022 on a trailing 12-month period. It's turned it up, it's hit an inflection point, and it's now generated 25.57 million in cash flow from operations in the most recent 12-month period. So I like what I'm seeing from the company's revenue growth, from its expansion in profitability, and its expansion in cash flow from operations. And all of that comes with a stock that's selling at an inexpensive valuation of a forward price to earnings of just 22. This is a valuation you're more likely to see from a company that's barely growing revenue and earnings, and now you're getting this valuation from a company that is growing revenue, earnings, and cash flow robustly. Now, some of this concern may be because as economies are reopening, more and more people are comfortable visiting a doctor's office in person versus visiting a doctor's or having your appointment over the phone or over the internet. Still, despite that near-term snapback to more visitation in person, longer term, like I mentioned earlier in the video, I think the convenience factor is just going to drive so much more visitation online or over the phone or over a Zoom call, whatever it might be, but not in person, just because it's just so much more convenient to do it over the phone, and it's so much less costly. It saves doctors' offices so much more money by having the call over the phone or having the visit over the phone or in person. So this is one company that's down 74% off its high that you could buy now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.